Preparing for a credit portfolio analyst interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does a credit portfolio analyst do? A credit portfolio analyst looks beyond one borrower and asks how the whole book behaves under different credit conditions. I monitor exposures, ratings, covenants, concentrations, migration, defaults, recoveries, and risk-adjusted return. The job is to spot deterioration early, explain drivers to senior stakeholders, and recommend actions like reducing exposure, tightening limits, hedging, or reallocating capital. Strong analysis connects individual credit judgment with portfolio-level risk appetite discipline. While answering, focus on portfolio-level monitoring, exposure management, credit quality trends, concentration risk, early warning indicators, and how the role connects individual credit analysis with enterprise risk appetite. Question 2. What are the most important credit portfolio risk metrics you would track? I would track both risk and return metrics. On the risk side, I focus on exposure at default, PD, LGD, expected loss, rating distribution, watchlist balances, non-performing loans, and concentration by sector, geography, borrower, and product. I also monitor migration trends because deterioration often appears before defaults. On the return side, I compare spreads, fees, RAROC, and capital usage to see whether the portfolio is being compensated for the credit risk. Make sure to cover exposure, weighted average rating, probability of default, expected loss, non-performing loans, watchlist names, sector concentration, limit utilization, credit migration, and risk-adjusted profitability. Question 3. Explain PD, LGD, EAD, and expected loss in simple terms. Expected loss is the average credit loss we expect over a defined period. PD is the probability the borrower defaults, LGD is the percentage we lose if default occurs after recoveries, and EAD is the exposure outstanding at default. The formula is PD multiplied by LGD multiplied by EAD. For example, a $10 million exposure with 2% PD and 40% LGD has an $80,000 expected loss. That feeds pricing, reserves, and capital decisions. In your answer, define each component clearly, show the expected loss formula, and explain how these measures support pricing, provisioning, capital allocation, and portfolio risk comparisons. Question 4. How would you identify and manage concentration risk in a credit portfolio? Concentration risk is dangerous because a portfolio can look diversified by name but still be exposed to the same economic driver. I would analyze exposure by borrower group, industry, geography, rating band, product, collateral type, and correlated factors like oil prices or commercial real estate values. Management tools include limits, sublimits, stress tests, approval thresholds, and active reduction plans. The key is not just measuring concentration, but asking whether the portfolio is paid enough for it. Be sure to mention single name, sector, geography, rating, collateral, and correlated exposure concentrations. Explain limits, diversification, stress testing, portfolio reporting, and escalation when concentrations exceed risk appetite. Question 5. What is credit migration analysis, and why does it matter? Credit migration tracks how borrowers move across rating grades over time. I care about it because defaults are lagging indicators. Downgrades and watchlist movements usually tell the story earlier. If a portfolio is migrating from BBB to BB, expected loss, capital usage, and required spreads all change even before any default. I would analyze migration by sector, vintage, product, and underwriter to understand whether deterioration is broad-based or isolated to specific pockets. While answering, focus on upgrades, downgrades, rating transition matrices, watchlist movement, leading indicators, provisioning impact, capital implications, and how migration reveals portfolio deterioration before defaults occur. Question 6. How would you design a stress test for a credit portfolio? I start with a plausible but severe scenario, such as recession, higher rates, falling collateral values, or a sector-specific shock. Then I translate macro assumptions into borrower-level PD, LGD, and rating migration impacts. I would look at expected losses, stressed losses, capital consumption, covenant breaches, and concentration hotspots. A good stress test is not just a number. It should drive decisions like limit changes, additional monitoring, hedging, or reducing vulnerable exposures. Make sure to cover scenario selection, macro variables, sector sensitivity, PD and LGD shocks, exposure assumptions, concentration effects, loss estimates, capital impact, and management actions after results are reviewed. Question 7. What early warning indicators would you monitor for credit deterioration? I would monitor a mix of borrower-specific and market signals. Financial indicators include falling revenue, margin compression, rising leverage, weaker interest coverage, and negative free cash flow. Behavioral signals include late payments, revolver drawdowns, requests for covenant relief, or delayed reporting. Market indicators could be widening CDS, bond price declines, or negative sector news. I would not overreact to one data point. I look for patterns that justify watchlist placement or deeper review. In your answer, talk about financial, behavioral, market, covenant, management, and industry signals. Emphasize trend analysis, not one-off movements, and explain how indicators trigger escalation. Question 8. How do covenants help manage credit risk in a loan portfolio? Covenants are an early warning and control mechanism. Maintenance covenants require borrowers to stay within agreed financial thresholds, such as leverage or interest coverage, while incurrence covenants restrict actions like taking on more debt or making acquisitions. If a borrower trips a covenant, lenders can renegotiate terms, request more information, adjust pricing, or reduce exposure. For a portfolio analyst, covenant headroom trends are often more useful than a simple pass or fail view. Be sure to explain maintenance versus incurrence covenants, financial tests, reporting requirements, early intervention value, waiver decisions, and how covenant trends affect portfolio monitoring and risk grading. Question 9. How would you assess whether a credit portfolio is generating adequate risk-adjusted return? I would compare the return earned against the credit risk and capital consumed. Gross spread alone is not enough, because a high-yield borrower may also bring high expected loss and capital requirements. I would calculate risk-adjusted return using income, fees, expected loss, expenses, and allocated capital. If RAROC is below the hurdle rate, the bank may need higher pricing, better collateral, lower exposure, or an exit plan. Portfolio quality is about compensated risk. Make sure to cover spread income, fees, expected loss, operating costs, capital allocation, RAROC, hurdle rates, risk-adjusted pricing, and identifying exposures that consume capital without adequate compensation. Question 10. What is the purpose of credit limits, and how would you monitor limit utilization? Credit limits translate risk appetite into practical boundaries. They can apply to a single borrower, borrower group, industry, country, rating band, or product. I would monitor both committed and drawn exposure, because undrawn commitments can become funded quickly in stress. Utilization trends matter as much as current breaches. If a sector limit is nearing capacity, I would flag it before new deals are approved so the business can prioritize the best risk-adjusted opportunities. While answering, focus on risk appetite, borrower and sector limits, committed versus drawn exposure, utilization trends, exceptions, breach escalation, and how limits prevent excessive correlated credit exposure. Question 11. How do macroeconomic factors affect credit portfolio performance? Macroeconomic conditions affect both default probability and recovery value. Higher interest rates can pressure borrowers with floating rate debt by reducing coverage ratios. Inflation may help revenue in some sectors, but hurt margins where costs cannot be passed through. Unemployment affects consumer credit, while commodity prices matter for energy and materials borrowers. I would map macro variables to sector sensitivities, then look for rating migration, covenant pressure, and higher expected loss in the exposed parts of the portfolio. In your answer, connect rates, inflation, unemployment, GDP growth, commodity prices, FX, and asset values to borrower cash flow, leverage, defaults, collateral recovery, and sector-level risk migration. Question 12. If a relationship manager proposes a new large loan, how would you evaluate its portfolio impact? I would first assess the borrower on a standalone basis, but the portfolio question is whether the exposure improves or weakens the book. I would check sector and single-name limits, correlation with existing borrowers, rating impact, expected loss, capital usage, and risk-adjusted return. A strong borrower may still be unattractive if it adds to an already crowded sector at thin pricing. My recommendation would balance relationship value with portfolio diversification and return discipline. Be sure to mention standalone credit quality, incremental concentration, limit capacity, correlation with existing exposures, expected loss, capital usage, pricing, collateral, covenants, and whether the deal improves portfolio return. Question 13. A key borrower is downgraded 2 notches. What actions would you take? I would first understand whether the downgrade reflects temporary pressure or structural deterioration. Then I would review current exposure, undrawn commitments, covenant headroom, collateral coverage, liquidity, and peer trends. I would update PD, expected loss, capital impact, and any watchlist classification. If the risk has materially changed, I may recommend tighter monitoring, reduced availability, repricing, additional collateral, or an exit strategy. The response should be proportionate, timely, and well documented. Make sure to cover exposure review, reasons for downgrade, covenant headroom, collateral value, rating migration, expected loss update, watchlist process, communication with relationship managers, and potential risk mitigation actions. Question 14. How do you balance credit model outputs with qualitative judgment? Models are useful because they impose consistency across a large portfolio, but they are not a substitute for credit judgment. A model may capture leverage, coverage, and payment history, yet miss weak management, customer concentration, accounting quality, or industry disruption. I would use the model as a starting point, challenge unusual outputs, and document overrides clearly. The best process combines quantitative discipline with qualitative insight, especially when conditions are changing faster than historical data suggests. In your answer, explain that models provide consistency but may miss borrower-specific issues, management quality, industry disruption, data limitations, and forward-looking risks. Question 15. What would you include in a monthly credit portfolio report for senior management? A senior management report should be concise, decision-oriented, and trend-based. I would include total exposure, utilization, rating distribution, migration, watchlist movements, non-performing loans, expected loss, concentration by sector and geography, limit breaches, and stress test highlights. I would also show risk-adjusted return and capital usage, not just credit losses. Most importantly, I would call out emerging risks and recommended actions because management needs insight, not just a data dump. While answering, focus on executive-level clarity, exposure trends, concentrations, rating migration, watchlist names, limit breaches, stress results, expected loss, risk-adjusted return, emerging risks, and recommended management actions. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.